Wood TV Live Desk.
And good morning, everyone. Phil Pinarski here with the Wood TV Live Desk. Hope you're all having a great start to your Tuesday. The big story over the past couple of days really has been this collapse of multiple banks here in the United States, specifically with the Silicon Valley Bank out in California, and the subsequent fallout from other regional banks across the country. Stocks have taken a bit of a dive. Bailouts have been planned, and there are plenty of questions that remain here that have stretched even here into Michigan. And so joining us today to talk a little bit more about that and answer some of those questions is Nick Yulee. He is the Chief Investment Officer over at Greenleaf Financial. Nick, thank you so much for being here today.
Thanks for having me, Phil. Glad to be here.
Absolutely. And I guess, we kind of should just jump straight into this. I know people are going to have a lot of questions, but I guess the main thing is for some people that may not be able to understand it, or, it is a complicated issue, or maybe they don't even know where to begin with these questions. Could you try to explain this very complicated issue in, layman's terms as easy as a way for people to understand as possible?
Absolutely. And like you said, I'll do my best to make it as straightforward and easy to understand as we can. There's a couple things to point out here. So what we're talking about, the couple of banks that have failed, these are depository institutions. And so these are banks that take in deposits either from individuals like you and myself in our checking and savings accounts or from businesses. And what banks do, depository and lending banks do, is they take in deposits, they hold that money safely for their clients. And on the flip side, they use those funds basically to try to make a spread. They will either invest them in fixed income securities. They might lend them out for different business ventures and things like that. But then you would expect as a client, and you and I, Phil, as people who probably have a savings account somewhere, when you'd like to go get some of your money out, you go to the bank and you ask for it back. And of course, they've got enough reserves in place that they give you what you ask for. What happened with Silicon Valley Bank in particular, it's basically the prime example and the one that really kicked off the whole concern here, is they had taken in a lot of deposits in 2020 and 2021 from small startup companies, venture capital startup companies. So these are business clients for the most part. They took in a lot of deposits and things were going good. They're bringing in money, more money's coming in each day. These startup companies are raising lots of funds, they're depositing it at the bank. And what the bank did is they took those funds and they invested them primarily in U.S. Treasury securities, so bonds, but longer term bonds, not the shortest, safest ones, but the ones that come due over longer periods of time. Flash forward to 2022 and then entering 2023, these startup companies were having less luck raising new money. So unlike you and me, who maybe put a little bit into the savings account each month, they stopped raising new money. They stopped putting money into the savings account. So inflows of deposits at Silicon Valley Bank dried up. At the same time, these startup companies who need that cash to fund day-to-day operations started withdrawing money. So they're taking their deposits out. Unfortunately, the securities that Silicon Valley Bank had put the deposits into had depreciated in the short term based on higher interest rates from the Fed. And that meant that when these startup companies came and started asking for their funds, Silicon Valley Bank ran into an issue where they weren't able to provide that liquidity. They weren't able to give back all the money immediately that they had taken in. It got compounded by the fact that Silicon Valley is a very sort of small, tight-knit neighborhood, if you will, and word travels fast. So all of a sudden, if you were trying to get your money out from Silicon Valley Bank and there was rumor spreading that they weren't able to make their return their deposits, people weren't going to wait around to see if Silicon Valley Bank would be okay. They said, we want our money back now, to the tune of in excess of $40 billion in withdrawals in one day last week. So you pull out all your funds, the bank can't meet all those requirements, and that constitutes a bank failure. And that's exactly what happened. The bank basically was not able to meet the withdrawal requests of its clients. It failed, and it was taken into receivership by the FDIC. So that's as simple as I can make it. I want to be clear, this is not like the questions I've been getting asked over the course of the last week are, how do I know that same thing doesn't broaden out, that doesn't become more of an issue within the broader financial system in the larger banks? And, people are hearkening back to 2008 and what happened there. Let me be very clear. This is much simpler than that. First of all, so in 2008, we're not talking about acres and acres of empty homes that are built in the outskirts of Las Vegas that have been bought and sold 17 times, rolled up in derivatives of derivatives of derivatives, and sold all throughout the banking system. We're literally talking about, a bank where people made deposits, and when they went to withdraw their money, the bank was not in a position to give all their money back.
Mm-hmm. And you did touch on that about how this isn't going to maybe play out into the similar financial crisis we saw in 2008. We've heard from the U.S. Department of Treasury also kind of mentioning that, saying that the banking sector is resilient and that this isn't really going to happen. But we're just playing devil's advocate here, could you see this potentially getting bad? Could this lead into further spread out? We saw it impact Asian markets, just kind of the stocks and everything impacting there, and then also in Signature Bank in New York having to be shut down as well due to similar things. Could this fear really lead to something even far greater?
So fear is certainly a wild card. As I take a closer look at the fundamentals and the actual concerns and dynamics that have caused these handful of banks to fail in the last week or so, I struggle a lot to see how this bleeds into a broader contagion where we find similar concerns, similar challenges at the most important, largest banks in the United States, which basically constitute our broader banking and financial system here. So why do I say that? First, I think it's important to understand sort of the landscape of banks, of U.S. banks in general. So before it failed, Silicon Valley Bank was the 10th largest bank in the United States in terms of its assets. When I say that to you, you think, oh my gosh, the 10th largest bank, this is a major going concern. This is the 10th largest bank failed, and you're hearing a headline, the largest bank failure since '08. Yes, it's a large bank. But that being said, if you look at the spectrum of banks, being the 10th largest in the United States actually makes it not top tier, not second tier. It actually puts it in about the third tier of that space. So the top tier of banks is basically four players. It's going to be JP Morgan, Citigroup, Wells Fargo, and Bank of America. The next leg down, you've got about three banks. I believe it's PNC, US Bancorp, and Truist. And then you take another big step down to what we call the regional banks. And that's where you would find Silicon Valley Bank and 10 to 15 others that kind of constitute that third tier. So to give you a sense for the scale, it would take 15 to 20 Silicon Valley banks to equal one of those top tier banks that I mentioned, a Wells, a JP Morgan, a Citi, a bank like that. So first of all, while it's the 10th largest bank and one of the larger banking failures that we've seen in the last couple of decades, again, it is small in the context of the U.S. banking sector, and in particular when you look at how concentrated it actually is in that top tier. Mm-hmm. The other things, there were some very company-specific circumstances that were a problem for Silicon Valley Bank and for Signature Bank. And the issues are these. Basically, what I'm going to talk about is the size of the bank and the diversification of their depositors. And tangentially, I'll also mention how insured their deposits were. I'll get to that last. But a couple of things. First of all, Silicon Valley Bank, as the name would suggest, is a regional bank that operates primarily in Silicon Valley. And it caters to, as I mentioned before, these venture capitalists and the startup companies that they're investing in. So if you've got a very undiversified depositor base, everybody who's depositing funds at your bank kind of looks the same, is kind of the same type of business, same type of profile, then they are going to be at risk for the same sets of circumstances. So a challenge that presents to one of your depositors may very well present to all of your depositors. And that's an issue. So if you've got a bunch of startup companies, like I said, who they were able to raise a lot of money in 2020 and 2021, also all those same startup companies and venture capitalists had challenges raising money in 2022. So your whole depositor base experienced that same challenge. Venture capital startup firms in general, they're by their nature, they are burning money to fund day-to-day operations. They're not profitable. They're not generating their own cash flow. So their characteristic is they're pulling money out when they can't raise it on their own. And so your entire deposit base has that same characteristic, is dealing with the same set of circumstances, starts pulling money out at the same time. The challenge that they ran into again was that Silicon Valley Bank, what they had done with the deposits was something that in the long term would have been fine, but in that short period of time, I don't want to get into the weeds, but with rates increasing super quickly, their bond portfolio dropped, and then they weren't able to meet deposits. So you've got a smaller bank with a very sort of niche, consistent depositor base who all ran into the same issues at the same time. In addition, I want to touch on that third point, which was how insured are the deposits. So some of you might be familiar with the FDIC. In a nutshell, if you've got money in a savings account or a checking account at your bank, at Chase, at B of A, wherever, those deposits up to $250,000 are insured by the FDIC. If that bank gets scraped off the face of the earth, ceased to exist tomorrow, the FDIC will make you whole up to $250,000 in deposits at the institution. At Silicon Valley Bank, many of these startup companies, and these are business accounts now, greatly exceeded $250,000 a piece. And so when you look at what was actually insured, what the FDIC would cover, it was only about 30% of the total deposit base, which meant 70% was not insured, was basically at risk. If the bank were to go under, you wouldn't get your money back prior to the Fed stepping in. We'll get there in a moment. But what happened was, if you look at like a Bank of America, for example, or one of those four top tier banks I mentioned, much more diversified client and depositor base. They've got everything from people like you and me to venture startups to small businesses to large businesses, a much more diversified depositor base, which means if you have a scenario where one portion of your deposit base needs to make significant withdrawals, in general, you don't have to worry about a large other portion of your depositor base doing the same thing at the same time. Silicon Valley Bank also much smaller, so different areas to be able to pull reserves from, et cetera. And lastly, again, with being so uninsured, Bank of America, for example, which is going to have a gajillion accounts, again, like you and me, Phil, with our emergency fund, the money that we keep on hand to pay the bills with, all that are going to be under $250,000, or many of which, and their insured rate is going to be somewhere in the 90s. Again, compared to SVB, Silicon Valley Bank, which had an insured rate of around 30%. So very unique set of circumstances. And as you look around, you say, well, can't this happen to other depository institutions, other banks? Sure. Any bank, any depository institution is at risk of a run on its funds at any time. In theory, every client, no matter how diverse, could show up at the doors of JP Morgan and say, we want our deposits out today, and that would be a massive problem for them. But they're diversified, they're large, they're highly insured, not so much of a risk there. But if you look across the landscape of smaller regional banks, sort of like Silicon Valley Bank, yes, there was additional risk that their peers might have similar circumstances. Very narrow client base, smaller asset levels, underinsured, that could cause a run on their funds, and that could have happened. And in fact, we had a total of 3 banks that failed over the last week or so. Fortunately, you did have the Federal Reserve and the Department of the Treasury step in and do a few things to help. So what did they do? They said, first of all, across the banking system, forget the FDIC, we will backstop all of your deposits. So whereas I'd be insured up to $250,000 at Bank of America with the FDIC, if I had $1 million sitting there, now the Federal Reserve is saying, don't worry, we will make sure you're made whole for your $1 million. We will take care of that. So we're fully insured now. They also said, okay, some of these smaller banks may have trouble in the short term meeting these liquidity needs, just like Silicon Valley Bank did. Before they have a run on their bank, before they fail, we will give them more of an opportunity to borrow from, it's called the discount window, but to borrow from the Federal Reserve over the short term to bridge those gaps. So they're saying, yes, we will make sure you've got money, liquidity available to you to pay depositors if they want to make withdrawals. And oh, by the way, if you've got assets like Silicon Valley Bank did that were temporarily reduced in value, you can use those as collateral. Give those to us. We'll give you their full value in cash today. again, to help you meet those liquidity needs. And those steps that they took did a lot to shore up what remains, the banks that didn't fail in terms of the regional banking space. But more importantly, in my opinion, it really placated the fear. And you mentioned fear earlier. It placated the fear that anyone who's got their cash sitting at a regional bank might be concerned that their bank would be next to fail. What you don't want, ideally, is you don't want everybody withdrawing their funds from the smaller banks. It's disruptive. It can lead to kind of a vicious cycle where you end up with an SVB type of outcome. And so I think what they did was they shored it up financially, but they also, like I said, they placated that concern that depositors might have keeping their funds at some of these regional banks. Long story short, long-winded answer to your question, I do think you'll continue to see some movement of deposits away from some of the less diversified smaller banks to probably the more diversified larger banks. I kind of think of that as a flight to safety, but I don't think you're going to have those same types of challenges at the larger banks, and the Fed and the Treasury have stepped in to sort of, cushion against those same challenges even at the smaller banks moving forward.
Mm-hmm. And I guess kind of my next question, Nick, would be, you talked a little bit about the steps that the federal government, the Treasury have sort of taken to help out Silicon Valley Bank. A lot of people may be concerned about, the FDIC, as you said, it backs up to $250,000, but these small businesses have millions of dollars in there, and they're all being told that they're, going to have that money. People are worried where that money is coming from. They may think that their tax payments may actually be going into that, but that's not necessarily the case. Can you talk a little bit about that?
Sure. I've gotten that question a lot over the last few days. Why should my tax dollars bail out these, this bank and its depositors who, may have taken on additional risk, what have you? Absolutely not the case. And so what did the Federal Reserve say? They said, we will backstop all of your deposits that are at any U.S. bank. That does not mean that they're suddenly overnight going to write a check for all the deposits that exist at U.S. banks. What it means is they will take steps to ensure that you have access to that money, that you can get your money out, that you can get that liquidity. And when you think about SVB, for example, frankly, a short-term problem with not enough time to see it through. So the securities that they purchased with the deposits, they weren't super risky. These were, many of them U.S. Treasuries, but they were longer term in terms of their maturity. So they weren't 6-month Treasuries where there's very little risk associated with them. They were 10, 20, 30-year Treasuries. And those types of assets, when interest rates rise, their price falls in the meantime. But if you hold them to maturity, they get back to that full value. So what happened with SVB? They were taken over by regulators. The bank failed. The regulators take over. Everything's seized, and it's moved into receivership. Receivership means they're selling off all the assets. So they're going to take everything that this bank has, and they're going to basically liquidate everything that exists, pay out all the depositors, make sure that they have liquidity available to them. And to the extent there's a shortfall, two things can happen. A, the Federal Reserve can print a little bit of money to bridge a small gap. We're not talking about, the entire, multi-billion-dollar asset base of SVB. We're talking about, what didn't get met by the liquidation in the short term. But the receiver is also going to take on, those longer-term treasuries, for example, which eventually will regain their value. So this is not I wouldn't think of this as a stimulus or where we're going to, take on an additional, trillions of dollars onto the Fed balance sheet. This is literally a message. We've said, we'll make sure that you're whole. We'll backstop, the deposits in excess of $250,000, which is already covered by the FDIC, because in the short term, the banks, the couple of affected banks can't quite make it happen. So at the end of the day, when you think about the total deposits are there, the funds are there, the value is there, just this immediate liquidity wasn't available. So they're bridging a small gap, not coming out of taxpayer dollars. It really, again, that message of, we promise to backstop it if there's a problem. Right now, there's not really a very large problem that needs backstopping.
Right. And Nick, we are running a little bit out of time here, but real quickly, I know a lot of people are kind of concerned about this. You did a fantastic job of really explaining everything and really trying to bring the fear down a bit, but there are people that maybe want to be prepared in case something does get worse or maybe their bank is impacted. What are some of the key things that people should kind of pay attention to and also do to prepare themselves for something if it did reach that level at their own bank?
Yeah, so I mean, right now, based on what the Fed and the Treasury have put in place, you're pretty safe. Frankly, even if we were to have another bank fail or have a run, and you had more than $250,000, it might be disruptive to you in terms of it might take a few days for you to access your money or to work through the system that the Fed is putting in place. But you don't have to worry about. I mean, the Federal Reserve has guaranteed that if you have $1 million in the bank, you will get it back. Now, these are not investments, but these are your deposits, right? You'll get that money back. I would tell you more broadly, though, it's a great reminder, to the extent you're sitting on more than $250,000 in, cash savings in a bank deposit account. The Fed may not always, they have a history of showing up and sort of backstopping larger balances, but they're not always going to be in that position. And so, if you're holding more than $250,000 in an account, you might want to diversify that across more than one institution so that the FDIC will cover you at both institutions up to $250,000. That's number one. Secondly, if you're still concerned, which again, I'm telling you, I don't think you need to be, but if you're still concerned about your deposits at your regional bank, big picture, you would be safer to hold your deposits, at one of the top tier banks, which again is more diversified in its deposit base and it's got more resources to pull from. It's not my recommendation. I would not be sounding an alarm suggesting, hey, if you've got money at any one of the regional banks, that today I think you should go pull your funds and move them. But if you're somebody, if it's keeping you up at night, that's probably the direction you'd want to head in.
Right, awesome. All right, Nick, well, we really do appreciate you stopping by the Wood TV Live Desk today. Great information, great insight. We really do appreciate it. Thank you so much for coming on this morning.
Thank you for having me. Appreciate it.
And I want to thank everybody else for tuning into this latest edition of the Wood TV Live Desk. I'm Phil Penarski, and we hope you have a great rest of your day.